My name is Michael Grandy. I'm a professor at Providence College, and I'm presently teaching a graduate course in the MBA program, MBA 603, which is essentially the graduate version of managerial accounting. And today's conversation is we're going to look at some problems, specifically dealing with standard costs and variance analysis. We have some problems that we've picked out from the Garrison, Noreen, and Brewer book, in specifically chapter 10. So the first exercise I'd like to look at is exercise 10-1. So the first three of these problems are going to be very straightforward, very simple variance analysis problems where we are calculating direct materials, direct labor, and variable manufacturing overhead variances. Very straightforward, very simple. The fourth problem we look at is going to have some complications to it. It's going to be a little bit more intense. But let's first take a look at exercise 10. That's the chapter 1. Bandar Industries manufactures sporting equipment. One of the company's products is a football helmet that requires a special plastic. During the quarter ending June 30th, the company manufactured 35,000 helmets. Using 22,500 kilograms of plastic, the plastic cost the company $171,000. So as I've mentioned in our lectures, you need to be able to distinguish between the actual information and the standard information. You just listened to the actual information. Now we need to look for the standard information. According to the standard cost card, okay, what is the standard cost card? The standard cost card is a summary of the quantity and price assumptions, the quantity and price standards for the company. According to the standard cost card, each helmet should require 0.6 kilograms of plastic at a cost of $8 per kilogram. So right there, they just gave you the quantity and price standard. Now, the problem asks for a bunch of things, but fundamentally, what we are looking for is to calculate the direct materials variances. I want 3 of them. I want you to calculate the overall, also known as the spending variance. I want you to also calculate the price variance and the quantity variance. So let's take a look. I like to use the chart. And over here on the left-hand side, we have the actual cost. We also have the standard cost over there. And let's remember that the standard is also the flexible budget. Pardon me, not a room. The flexible budget, because remember what the flexible budget tells you. It tells you what it should have cost at the actual level of output. So let's work with that number first. It said that they actually produced 35,000 helmets, and it should have taken 0.6 kilograms to make this. Therefore, they should have used 21,000 kilograms. That is the standard quantity. Now, what is the standard price? The standard price, SP, is $8. So remember, this over here is SQ times SP for a total of $168,000. That's what they should have spent to produce those 35,000 units. Well, what did they actually spend? Well, they said they actually spent, the plastic cost the company $171,000. So you have a spending variance the overall variance of $3,000. Is it favorable or unfavorable? Well, they should have spent 168. They actually spent 171. So this is what? This is unfavorable. favorable variance. But we're interested in the price variance. This is the price variance over here, we're going to see in a minute. And this is the quantity variance. So we need to look at the middle here, where we're looking at AQ times SP. So what was the actual quantity? Well, they told us in the problem that the actual quantity was 22,500 kilograms. And they said that the price they paid was a total of 171. So what was the actual price, right? Because remember, this is AQ times AP. AQ is the 22,500. What is AP? Well, they didn't tell us, but we can figure it out because they spent a total of 171,000 for 22,500 kilograms. They spent $7.60 to get to 171,000. So over here, again, what are we looking for? We're looking at the actual quantity, 22,500, times the standard price of $8. So you can see a couple of things coming into play, right? You can see that they should have spent $8 per kilogram. They only spent $7.60 a kilogram. You can say they had a savings of 40 cents per kilogram over these 22,500 kilograms. They have a favorable variance, $9,000, favorable price variance, because this number here works out to be what, $180,000. So the difference between the 180 and the 171 is your $9,000 favorable variance. And I say what? They did a good job purchasing, right? They saved 40 cents. They saved 40 cents a kilogram. But what about usage? Well, they should have used what? They should have used 21,000 kilograms. They actually used 22,500 kilograms. They used 1,500 grams too much at $8. They have a $12,000 what? Unfavorable quantity variance. They used too much. So even though they got a deal at 40 cents, the deal wasn't good enough to overcome the usage problem. So they had an overall unfavorable variance. Let's take a look at another problem. This one is going to be a direct labor. And this is exercise 10-2. So let's read exercise 10-2. It says, Sky Chefs prepares in-flight meals for a number of major airlines. One of the company's products is grilled salmon with new potatoes and mixed vegetables. During the most recent week, okay, here's the actual information, right? The company prepared, past tense, 4,000 of these meals using 960 direct labor hours. The company paid its direct labor workers a total of $19,200 for this work, or $20 per hour. That's the actual information. Now we have to find the standard information. According to the standard cost card for this meal, it should require 0.25 direct labor hours at a cost of $19.75. So again, let's calculate, number one, the overall spending variance for direct labor. And secondly, let's calculate the rate variance, and let's calculate the efficiency variance. And again, we like to use this format. We have actual, which is AQ times AP. We have AQ times SP. And we have the standard, also known as the flexible budget, SQ times SP. And I'll tell you right now, as I tell all my other students, SQ is the most difficult number to come up with, because SQ in this example tells you how many hours they should have used for that actual output. Well, what was the actual output? The actual output was 4,000 meals. How much time should they have used per meal? 0.25 hours. They should have used SQ, they should have used 1,000 hours. Times the standard price. The standard price, they said, was $19.75 per hour. So they should have used 1,000 hours, and they should have paid their employees $19.75 for a total of $19,750. What did they actually pay? Well, they actually paid, as they said, $19,200. For an overall variance, your spending variance of $550, and that's what? That is favorable, right? They should have spent $19,750. They actually spent $19,200. Favorable variance. But once again, you're interested in the rate and efficiency variances. The rate variance and the efficiency variance. Well, what was the actual quantity? The actual quantity, they said, they spent 960 hours. That's AQ. We know the standard price, $19.75, but what was the actual rate? Well, they don't tell you, but you can very easily get it, right? $19,200 divided by 960 hours. They paid them $20 an hour. So you can see that this number in the middle here will multiply out to 18,960. 960 times 975. So we have our rate variance, the difference between these two numbers, which is 240. Unfavorable, right? It's 25 cents, $20 minus 1975, 25 cents times 960. They were unfavorable rate variance because they paid them 25 cents more an hour. But what about the efficiency variance? Well, the efficiency variance, they should have used 1,000 hours. They actually used 960 hours. That's 40-hour savings. At $19.75, this is a $790 favorable variance. They were efficient, and they were efficient enough to justify paying them 25 cents more an hour. Why? Because the overall variance is favorable. Okay. Let's look at a variable overhead problem. And this is going to be exercise 10-3. And this is a variable manufacturing overhead problem. Let's read it. Logistics Solutions provides order fulfillment services for .com merchants. The company maintains warehouses that stock items carried by its .com clients. When a client receives an order from a customer, the order is forwarded to Logistics Solutions, which pulls the item from storage, packs it, and ships it to the customer. The company uses a predetermined variable overhead rate based on direct labor hours. Please remember, when it comes to overhead, whether it is variable or fixed, the standard price equals the predetermined overhead rate. In the most recent month, here comes the actual information, right? In the most recent month, 120,000 items were shipped. That's the actual output. To customers using 2,300 direct labor hours. The company incurred total of 7,360 in variable overhead. According to the company standards, okay, here's the standard information. 0.02 direct labor hours are required to fulfill an order for one item, and the variable overhead rate, the standard price, $3.25. Calculate spending variance, calculate rate variance, calculate efficiency variance. And again, we're using the same format, actual AQ times AP, the standard SQ times SP, and again, the standard is the flexible. In the middle here, we got AQ times SP. So let's work with the actual side first, right? They just told us that they spent $7,360. And they told us that they used 2,300 hours, but they did not tell us the rate. But we can easily come up with the rate by taking 7,360 divided by 2,300 hours is $3.20. Let's go over to the standard. Again, they said their actual output was 120,000 items. It should take 0.25 hours. They should have used what? I'm sorry, not 0.25 hours. 0.002 hours. I even got that wrong. My apologies. 0.02 hours. 120,000 units, taking 0.02 hours. They should have used 2,400 hours. The standard price, $3.25. They should have spent $7,800. They should have spent $7,800 on overhead. They have a spending variance of $440 favorable. So the middle numbers here, we've got 2,300 actual hours times standard price of $3.25. This number here in the middle adds up to $74.75. Difference between these two numbers are the rate variance. And you can see the standard price was $3.25. They ended up at $3.25 cents per hour savings. For 2,300 hours, they have $115 favorable variance. What about the efficiency? Well, the efficiency is the difference between these two. They should have used 2,400 hours. They actually used 2,300 hours. They used 100 hours less than they should have. They were efficient at $3.25. This is $3.25 favorable. So they were both efficient and they saved on the rate for an overall variance of $440. So they were efficient. So let's look at something that has a little bit more complexity. Now, all of the problems that we were looking at when it came to direct materials, the things we looked at, that was the purchased quantity equals the used quantity. So in many of the examples we looked at, when it came to direct materials, the purchased quantity, that is what they purchased, equaled what they used, but that's not realistic. In the real world, companies always buy more direct materials than they need. Why? Because of waste, mistakes, theft, contamination, whatever the reason is, they always buy more than they need because they don't want to run out of material. Because if they run out of material, then the production line shuts down. So they always buy more than they need. So the likely situation is when the purchase quantity does not equal the used quantity. So what are we to do? Well, we need to do a couple of things. We need two separate calculations. So the price variance is going to be based upon what was purchased. And the quantity variance is going to be based upon what was used. Okay, and we're going to see an example just like that right now. This problem has some heft to it. It's not a short problem. It is somewhat complicated, but I think if we read it, go over it, understand it, you'll be in good shape. So let's read it and then we'll tackle it. This is problem 10-14. Becton Labs Inc. produces various chemical compounds for industrial use. One compound called Floodex is prepared using an elaborate distilling process. The company has developed standard costs for 1 unit of Floodex as follows. So the very first part of the problem, they give you all the standards. They give you direct material standards, direct labor standards, and variable manufacturing overhead standards, both quantity and price, which you can see in the problem. It goes on to say, during November, the following activity was recorded related to the production of Floodex. A, B, C, D, and E. Now, E, look what they did. Because you're looking for 3 things. You're looking for standard information. You're looking for actual information. And before you go anywhere, you really need to find what the actual output was. How many units did they produce? Because you cannot calculate standard quantity without it. Item E, at the very end of the problem, it says what? During November, the company produced 3,700 units of Floodex. That's the actual output upon which you are going to calculate standard quantity. So let's remember that. Actual output, 3,750 units. So A, materials purchased 12,000 ounces at a cost of $225,000. So they told you what they paid in materials. Before we go anywhere, B, there was no beginning inventory of materials. However, at the end of the month, 2,500 ounces of material remained in ending inventory. Whoa. So let's go back to financial accounting. Beginning inventory plus purchases equals goods available or materials available. Less ending inventory tells you what you used. In this case, beginning inventory is 0. They purchased 12,000 ounces and they have an ending inventory of 2,500 ounces. So how many did they use? They only used 9,500 ounces. So they purchased 12,000. They used 9,500, right? Because 2,500 is an ending inventory. Guess what? The purchase does not equal the used. So we have to have separate calculations for the price variance and the quantity variance. So let's take a look at that. Let's look at the price variance first. Price. Let's remember, it's based upon what was purchased. So AQ times AP times SP, right? AQ is what was purchased. And what was purchased was 12,000 ounces. The standard price, according to the standard cost card, was 20 bucks. So they should have spent $240,000. What did they actually spend? They actually spent $225,000. So you have what? You have a $15,000 materials price variance, which is favorable. Let's look at it another way. What's the answer for that box right there? Well, if you know the total, they spent $225,000 for 12,000 ounces, you know that they paid $18.75. They paid $18.75 per ounce. The standard was 20 bucks. You can see there's a $1.25 per ounce savings, favorable, over 12,000 ounces that were purchased, $15,000 favorable variance. I need to calculate the quantity variance. Remember, quantity variance is based upon what was used in comparison to what they should have used. So, AQ times SP versus SQ times SP. Let's work with the SQ first. They produced, remember at the very end of the problem, 3,750 units. The standard cost card says they should use 2.5 ounces. They should have used 9,375 ounces at a standard price of 20 bucks. The standard or the flexible budget was 187.5. How many ounces did they actually use? Well, remember, they purchased 12,000, but the ending inventory was 2,500. So they actually used 9,500 ounces. They should have only used 9,375 ounces. They used what? 125 ounces more than they should have. Times 20 bucks. This number is 190. This is your materials quantity variance right here, which is what? 2,500 bucks. 2,500 bucks what? Unfavorable. So they still did a good job overall, right? With this huge $15,000 favorable variance, but they used a little too much. That's still okay. That's still okay. Like I said, great price, use too much. What do they say? Asking here. The materials were purchased from a new supplier who is anxious to enter in a long-term purchase contract. Would you recommend that the company sign the contract? I think the answer is yes. Tremendous savings. Even if some of it was contaminated or spoiled, the materials quantity variance was insignificant in comparison to the price savings. So it's worth it. Yes, sign the contract. Let's look at labor. Again, this is still problem 10-14. It goes on to say, for direct labor, compute the rate and efficiency variances. Okay. B, in the past, the 35 technicians employed in the production of FloodX consisted of 20 senior technicians and 15 assistants. During November, the company experimented with fewer senior technicians and more assistants in order to reduce labor costs. Would you recommend that the new labor mix be continued? Okay. So we got to go back up into the problem and do what? We got to find what happened with actual direct labor. So we go into part C. It says the company employs 35 lab technicians to work on the production of Fledex. During November, they each worked an average of 160 hours at an average pay rate of $22. Okay, so we've got the actual information now. So these are direct labor variances. And again, we want to use this approach, AQ times AP, which is my actual information. I want to compare it to the standard, which is SQ times SP. And in the middle, I've got this AQ times SP that helps me isolate rate and efficiency variances. Let's work on the actual side first. What do they say? They said 35 technicians worked an average of 160 hours each. So they had total hours 5,600 hours. They said they paid them $22 per hour. Therefore, this number here, $123,200. Let's go to the standard side. Remember, the actual output was 3,750 units. The standard cost card says that it should take 1.4 hours per unit. So times 1.4 hours. They should have used 5,250 hours. The standard price, what they should have paid their employees, $22.50. For a total of $118,125. They should have spent $118,125. They actually spent $123,200. We have an overall spending variance of how much? $5,075 unfavorable. Now, before we actually calculate some numbers, let's take a look at a couple of things. What should you expect with regard to rate and efficiency? Let's talk about rate first. They should have paid them $22.50 an hour. They actually paid them $22 an hour on average. There's a savings there of 50 cents. You should expect to see a favorable rate variance. Let's talk about efficiency. They should have used 5,250 hours. They actually used 5,600 hours. They used 350 hours more than they should have. You should expect to see an unfavorable efficiency variance. So let's look up in here. Actual quantity, right? 5,600 hours. Standard price, $22.50 per hour. This number in the middle is 126. Difference between those two numbers is our rate variance, which is 2,800 favorable. Why? They should have paid them $22.50. They actually paid them $22.50 savings over 5,600 hours. Difference between these two numbers is our efficiency variance, and that works out to be 78.75 unfavorable. Why is it unfavorable? They should have used 5,250 hours. They actually used 5,600 hours. They were not efficient, hence unfavorable. Not efficient. What does the problem ask us subsequently? Would you recommend that the new labor mix be continued? Remember, we said they shifted from using more experienced people to less experienced people. I think the answer is no, because they were not efficient. The rate savings was not enough to overcome the big efficiency unfavorable variance. So let's look at one more. Let's look at variable manufacturing overhead. Again, this is still exercise 10, problem 10-14. Let's read the information. Item D, variable manufacturing overhead is assigned to Flood-X on the basis of direct labor hours. Variable manufacturing overhead costs during November totaled 18.2. So what did they right out of the box? They told you the actual cost for variable manufacturing overhead, right? $18,200. What's the standard? Well, remember, 3750 are the units. The should take 1.4 hours. They should have used 5250 hours at a predetermined overhead rate of 350. This is 18,375. So you can see the overall unfavorable variance of $175. Favorable, my apologies. $175 favorable. But what about the stuff in the middle here? AQ times SP. Remember, the actual hours were 5,600 from the previous direct labor variances versus 5,250. The standard price is 350. They don't give you that number, but you can figure it out. 18,200 divided by 5,600 is 325. So you can see a little bit of a savings there, right? This number in the middle, 19.6. So they have a rate variance here, right? This is the rate variance of 1,400 favorable. Why is it favorable? Because the predetermined overhead was at 350. It came in at 325, 25 cents per hour savings times 5,250. Bang, big favorable variance. But what? They continued to be what? Inefficient, right? I'm sorry, this number here. This is 5,600. My apologies. That number is 5,600 AQ, right? AQ. So they were not efficient. They should have used 5,250 hours. They actually used 5,600 hours. They were inefficient. So you see this 12.25 unfavorable variance. They were not efficient. But because of the rate, you had a net favorable spending variance. It goes on to say, what relation can you see between the efficiency variance and the labor efficiency variance? Well, they're both based on the number of hours. That's why they're not efficient. Okay, so that's a little bit more complex problem. That solution is obviously loaded on Sakai. So thank you very much and take care.